Hey traders, welcome to a global macro update. It'll be a different video this time to some degree. We're not really going to be looking at the US equities or gold and silver. We're actually going to be looking at a specific currency pair. It is the US dollar versus the Australian rand, or ZAR, depending on if you're Canadian or American. But we'll kind of break down the actual trade, the idea, the fundamentals to some degree, very briefly, and then we'll actually go over the price action, kind of overlaying the structure of what a Forex trade would look like in this environment, and also looking at the theory of the United States dollar gaining significant strength before the demise of that currency. I'm pretty sure if you are following our YouTube channel, that long term we are very bearish on the dollar because the central bank Keynesian economists that control the Federal Reserve will print as much as they need in order to try to curb deflation. Basically, they hate deflation. They're Keynesian economists who think that any sort of recession or depression should be combated by unprecedented balance sheet expansion, basically printing money. So without further ado, this is the counter argument for the dollar gaining weakness. At the end of the day, I think everyone has a unanimous agreement that fiat currencies are inherently devaluing as time goes on, as people print, or as central banks print more money. But it's the question of, if you're in the foreign exchange market, which currency do worldwide investors want more? It's not which one's better, it's just which one is more transactable and is more desired among worldwide investors. And the bias in the short term is going to be United States dollar because it is a world reserve currency, which we'll get into in a bit. But let's just start right here on with the video. First thing, we're going to quickly look at this economic calendar here. Today we've had some job numbers come out. Initial job loss claims worse than the forecast, but we're just getting some stagnation within the SPX, the spider, SPI, whatever you want to call it. Within this week, we've seen some CPI numbers come out in Euro and Canada. Worse than previous year, obviously, worse than the forecast for Euro. Other than that, building permits, not a whole lot. GDP for Japan is actually a pretty significant one, quarter over quarter. It's actually less bad than the forecast. They were forecasting as a negative 1.2, but they're only contracting less than 1%. So in a sense of GDP, it does look a little bit less bad. Obviously, it's not going to be great, but that's basically all we are going to go over. We got some PMI numbers from Germany, worse than the forecast. But overall, we'll see how the retail sales come out for GDP. They are forecasting some pretty negative results for the month of April, negative 16% in the retail stores. We'll see how that goes. And then we got core retail sales for Canada as well on Friday. But let's first go over this man, Brent Johnson. He's the person that I guess came up with what they call the dollar milkshake theory, and he's the person who is speculating that the US dollar will increase substantially in the short term, this year, next year, because there is a massive potential short squeeze on the US dollar. Now, if you don't know what a short squeeze is, it happened on Tesla, it happened in Volkswagen, it happens whenever there are markets that have people that bet that the market or the asset will go down, and there's a lot of people who are short it, like we saw in Tesla. And then when the value of that asset goes up, they need to buy that asset to pay back their broker, to pay back their exchange in order to settle the transaction. So we'll get into it a little bit later. Hopefully you understand what a short squeeze is, except this is the largest short squeeze kind of in existence. We've seen short squeezes in stocks and I'm sure crypto, but this is on a global, worldwide scale, talking billions, not hundreds of thousands or millions, maybe even trillions here. So the global dollar short squeeze. This is a really great article that I found that really illustrates it. Google this, global short squeeze. within this website, and you'll be able to find it without a problem. It gives some examples of the Volkswagen short squeeze that happened in 2008, I believe. But let's continue on reading what this global dollar short squeeze is. I'm going to get a little bit of water, and then we'll continue on here. All right. So first things first. Oh, I might sneeze. Nothing. Okay. The dollar is the primary global reserve currency. This is the primary key fundamental factor for this short squeeze. What does that mean? It is the international medium of exchange and significant store of value for most major countries, even though most of them use their own currencies domestically. What does that mean? So let's say, for example, Japan wants to conduct some business with any other international country for any commodities, goods, and services. What they'll most likely transact with, other than that goods and services, for example, oil, gold, silver, foods, they're going to most likely pay in United States dollars, even though their native currency is the Japanese yen. So this same holds true for many other commodities. So the United States dollar, as I'm sure many of you know, is the world reserve currency in which almost all countries transact internationally through that currency, which means if you are selling oil, if you are selling gold, silver, any real metal, any real commodity whatsoever, food, textiles, all that stuff, you're most likely going to be transacting in US dollars. So you'll be saying, for this certain amount of units for my asset, I want X amount of USD. Even if it is Switzerland talking to Brazil, you're going to still be transacting in US dollars because it is the most widely used medium of exchange for any commodity. That's an extremely big deal when you hold the keys to printing that asset. Extremely. You have tremendous amount of power. So, where lies the problem? The risky part of this system is that many foreign governments and corporations borrow in dollars, even though most of their revenue is in their local currency. The lender of those dollars is often not even a U.S. institution. Foreign lenders often lend to foreign borrowers in dollars. This creates currency risk for borrowers, a mismatch between their revenue currency and their debt currency. So this is the important part. They do this because a borrower can get lower rates by borrowing in dollars rather than their local currency, thus taking on currency risk themselves instead of the lender taking on that risk. So sometimes the dollar-denoted bonds and loans are the only option for them. So by doing this, the borrower is basically shorting the dollar, right? If you're borrowing in dollars, expecting to pay in dollars at a later point, if the dollar price or if the dollar value goes up compared to the currency you're using, it's going to cost more units of your native currency to buy that single unit of the US dollar. And we'll talk about this a little bit later. And then on the contrary, if the US dollar weakens, it takes less units of currency in your native currency in order to purchase 1 unit of the US dollar. All right, so for the dollar specifically as a global reserve currency, there is an extra variable due to all of this external debt. Ironically, the more dollar-denoted debt there is in the world, the more demand there is for dollars, because those borrowers need dollars to service their dollar-denoted debts. That can push the price of the value of the dollar further and hurt the dollar borrowers. It can have a short squeeze characteristics, in other words. Hopefully you understand the theory behind this. When there's more debt in the world, you inevitably have to pay back that debt. And if a lot of the debt is in United States dollars, which a lot of it is denoted, that means that you have to purchase United States dollars in order to pay for that debt. And if a lot of countries are indebted in US dollars, if there is a short squeeze where the United States dollar goes up, a lot of these countries will want to pay down their debts, right? If you borrow 1 Bitcoin, for example, and you convert it into, let's say, $10,000 in United States dollars, and now you're short Bitcoin, 1 Bitcoin, now you're short 1 Bitcoin. If the price of Bitcoin goes down half, you now made 50% of your money because you could purchase that same Bitcoin for half as much, and then you keep the difference, and that's how shorting works. But if Bitcoin goes up, you're now having to spend more dollars in order to purchase that single unit of Bitcoin that you borrowed earlier on. And this is what the problem is you need to purchase more of that asset in order to pay back your debts. And if it continues, it could create a chain reaction where everyone is trying to pay off their debts at the same time at an increasing US dollar, which is going to accelerate the need to pay down the debts. Because if you're not paying down those debts, your debt value compared to the native currency you're using is increasing, which is obviously not great. And, there's repercussions for not paying down debts. You gotta pay down debts sooner or later if you are trying to create any sort of relationship with the United States. They have the world reserve currency, they have the SWIFT system, they have a lot of relationships with many first world countries, obviously, so there is a huge benefit for working alongside with the United States. And if you are not able to pay down that United States dollar debt, well, there's going to be repercussions, right? So this next chart is actually going to show the central bank liquidity swap. What is this? Let's get this chart after. Let's first understand what this is. So the FOMC has authorized, so this is what this chart is showing, is when the FOMC has authorized, so basically temporary liquidity swaps. So central bank liquidity swaps with foreign central banks to help provide liquidity in the US dollar to overseas markets. So what does this mean? Let's say a central bank needs US dollar because they're transacting commodities with the United States dollar. They can't print United States dollar. They have to buy United States dollar with their native currency. United States, the Federal Reserve, they just get to print this stuff and give it to central banks. But other central banks can't print what they want to transact internationally. So they need to print their native currency and basically swap it for United States dollars. So let's go dive in deeper into what this is. These swaps involve two transactions. First, when the foreign central bank draws on the swap line, it sells a specified amount of its currency to the Federal Reserve in exchange for dollars at a prevailing market exchange rate. The foreign currency that the Federal Reserve acquires is placed in an account for the Federal Reserve at the foreign central bank. So this Federal Reserve has so much power because the foreign central bank needs to print money to give to the United States as currency that is depreciating, and then the United States has this commodity that every international country wants because they need it in order to transact on the international scale. That is the power of the Federal Reserve. So let's keep on reading here. The line in the statistical release reports the dollar value of foreign currency held under these swaps. So what does this show? It shows the amount of assets that the Federal Reserve has in foreign central bank accounts. So in 2008, a lot of central banks needed a liquidity provider for United States dollars. The only person that can provide liquidity for United States dollars out of thin air is the Federal Reserve. So the Federal Reserve created liquidity swaps, basically gave United States dollars to foreign central banks, and they gave the Federal Reserve more of their currency or the same amount of currency to provide kind of a collateral to some degree in their own bank account, and that's in that foreign central bank account. And we can see recently central banks are in dire need of US dollars. They're in dire need of US liquidity, and we can see that coming in right now. There's a huge pump in the central bank liquidity swaps, which means there's a lot of central banks that now have accounts in their central bank that say the Federal Reserve owns a tremendous amount of currency in our native currency because they provided us with liquidity when we needed it. So we know that there's more and more countries that are in need of United States dollars exponentially. Like, we haven't seen that in 2013, 2014, all the way until the COVID event. We haven't really seen any of that really needed, except for 2008, when obviously we had a massive spike in the central bank liquidity swaps. Next chart we're going to go to, hopefully you understand that, is going to be the biggest foreign holders of US debt on the chart. So we already talked about how if you borrow in United States dollars and the value of the dollar goes up, you're needing to spend more of your native currency in order to purchase the United States dollar. This is what a short squeeze is. Now, the next question I'm sure is, okay, what countries have the most US debt? Because if you're going to borrow a lot of United States dollars, that's a big short position you're basically taking on. And if the US dollar falls, that's great, you're making money. But if the US dollar goes up, you're put into a situation where you either have to get out of that trade, which is basically purchasing US dollar and then giving it back, and then you have to just suffer the losses of paying more per dollar, and that's how you get out of this trade. But let's just quickly look at the biggest foreign holders of US debt on one chart right here. Now, if you're trying to create a trade out of this, in my opinion, it makes sense to have two different pairs or currencies that are very different. So if you have one currency that is extremely strong that a lot of people want compared to a currency that not a lot of people want, that is a very risk-on asset, that if there is any sort of uncertainty or economic turmoil, investors are going to flee that asset, and you kind of know that as a high probability situation. So you're looking for a more safe haven asset compared to a risk-on asset, and the specific currency I chose in this example is going to be the South African Rand, which is ZAR, whatever you want to call it. And in this chart, it kind of shows what countries have the largest debt in US dollars, basically. And specifically, I think that it kind of makes sense to pair currencies that are more opposing compared to trying to trade a currency that has very similar currency strength, which is a lot harder in my personal view. So we see that Japan has a huge chunk of that debt, China as well, Europe has a lot as well. Switzerland, UK, Belgium, Luxembourg is crazy for kind of how small they are. Norway, France, Ireland, and then you also see Canada and Australia as well. Don't exactly know where Australia is on this chart, but you kind of have a good understanding of the percentages that we are able to see. All right, next chart we're going to go on is the global consumer confidence. This just kind of shows, this is just Q1 for 2020, so obviously this is just when the COVID kind of started to hit, and we can see the confidence from the consumers. And we can see America is doing very strong. The more green or blue, the better, and the more red, the less consumer confidence that they have, obviously. And we can see if you're looking for trade setups, you know, if you're looking for a big discrepancy versus blue and red. So if we're looking at some European countries, that's great. The Turkish lira is a great opportunity in my personal belief compared to the US dollar. We can see Japan's in the red as well. Australia is in the red as well. So Australian dollar compared to the US dollar would be a potential opportunity. And then we also see South Africa, the ZAR, the South African Rand compared to the US is pretty high discrepancy as well. So just kind of a quick, good understanding of more of the global consumer confidence is good to understand where we are on a global scale. Just quick letting you know before we get into the charts here, the South African Rand actually had a little bit of a bullish day today because they did slash interest rates. The South African Royal Bank here, we can see decisive cut to South African interest rates by the South African Reserve Bank, Reserve Bank, has sparked a rally in the value of the South African Rand as investors saw the move as ultimately being supportive of an economy that is under severe pressure, outing a strict in the coronavirus lockdown. And we can see this similar type of blog explaining that risk assets, including the Rand, have benefited this week from claims by U.S. biotech firm Moderna that it's made it progressive in developing a coronavirus vaccine with a larger ignoring fresh U.S.-China tension. So basically what this is trying to, what I'm trying to explain within this is that the South African Rand is a risk-on asset. It has a higher interest rate compared to the United States dollar. So when things are moving fine, when investors, when foreign exchange investors are at ease or feeling a little bit more optimistic about the future, they will look at the South African Rand because it has potential for higher appreciation, for one, and for two, it has a higher interest rate, it has a higher yield, so you get paid for holding it more than, for example, the United States dollar and many other European countries and Japan who have basically negative interest rates or almost zero interest rates or at zero interest rates. So when you're a global investor looking for yield, when you're hunting for higher yield, because you don't want 0.25% yield. You will be looking for less stable economies that have a potential to have high appreciation within their currency, and you kind of have a little bit of insurance because their interest rate is higher as well. But, obviously it's similar to holding a stock that has a higher dividend, but if the stock is depreciating and losing value, that dividend is still not going to support you losing money, because if you're adding the percentage of the dividend into your kind of net profit that you're expecting to have in a single year, but if the value of that asset depreciates more than that net kind of guarantee of that dividend, it's not a guarantee, obviously they can change it, but if you kind of have a speculation that they're going to continue the dividends, and if the price of the stock goes further than that benefit, obviously you're net negative and you don't want that. So this is the trade-off that global investors are looking at for this current trade-off. The United States dollar, which has a very low yield but is more stable and is going to perform better in uncertain times, compared to the South African rand that has more yield, more speculation, and it is a risk on currency that is providing a higher yield for yield hunters around the world, but is obviously going to depreciate much faster in uncertain times in the economy. So let's quickly look at the comparison here. This is two GDPs for a 10-year span, comparing the United States to South Africa. We see in a 10-year span, America's been averaging pretty good, let's say 2%. It's been more volatile in 2012 to 2014, but it was doing pretty well from 2016 before COVID, when we were sitting at a nice cool 2 to 3% in terms of the GDP growth rate, which is pretty damn good, which is, it looks pretty good in terms of GDP. When we're looking at the South African GDP growth rate on average, it's looking a lot weaker, with the average, let's say, sitting at 1.5, maybe even a little bit less in terms of just ballpark averages. So in terms of just GDP growth, obviously it doesn't look as favorable. Now let's look at the unemployment rate. Obviously this is a lagging indicator, but we can kind of have a good understanding of the people who are actually working in the workforce. We can see that before COVID, America has had a very solid employment rate compared to South Africa that was kind of stumbling in the 20s, and now it's almost getting at 30%, which is pretty unbelievable. So huge discrepancy in the people who are actually able to work in the workforce. Next thing we're going to be looking at is the consumer confidence. We already touched on this a little bit, but we can see that the consumer confidence for America was steadily increasing from the early 2010s onward, which is great, before COVID. And then for South Africa, there was a pretty big dip or a bump in 2018, but overall it's been not great. And we can see that in the GDP. We can see that in a lot of different indicators or economic indicators that we are looking at. So in terms of very short, quick understanding of the two different economies, South Africa is obviously struggling quite a bit. They were already technically in a recession even before COVID. They had two quarters of negative GDP, which is technically a recession. So even before COVID, the lockdown, social distancing, they were already in a recession. So obviously, very different situations that we are having within the economies. And for Forex trading, you're looking for which currency will have more demand. So in the short term, yes, as things settle, we may see some we may see interest hunting or yield hunting for more speculative investors. But if the uncertainty continues, I think the global reserve currency, which is the United States dollar, will gain significant demand compared to the South African rand. So we're going to look at one more thing here. This is comparing countries for different data sources. This is, in my opinion, a great website. It's called theglobaleconomy.com/compare countries. If you Google it, I'm sure you can find it. So let's quickly do a bit of an analysis. Obviously, this isn't going to be very extensive, but it's just a quick analysis for the comparison versus South Africa, which is blue, and the United States, which is red or orange. So capital investments as a percentage of GDP, the United States is moving to the upside, and then South Africa is moving to the downside. So you're looking for the directional movement or the momentum in which we are kind of anticipating. So obviously capital investments as a percentage of GDP, America is on the rise, and the United States, or America is on the rise and South Africa is on the fall. Unemployment rate, obviously, huge discrepancy. Obviously, this is only 2019, so we haven't seen COVID, but huge discrepancy in the unemployment rate. Next thing is the competitiveness. This is the business environment, and we can see that United States is increasing the competitiveness, which in my opinion is a good thing. When you have free markets competing with each other, you're going to get innovation, you're going to get entrepreneurs, you're going to get the people who are going to strive to innovate new technologies that are going to impact the world in a positive way. So competitiveness is a good thing to look at in terms of tech, in terms of new developments in the world, and South Africa is not really seeing that compared to the United States. All right, next thing we're going to look at is the political risks, which if you're investing in a country, if you're investing $10 million in a country, you want to have a very, to some degree, stable political environment, because obviously if you're investing in like North Korea or like Iraq or some sketchy place, you're not going to get that political stability that you're able to receive from a first world country like Japan, Canada, United States. These countries have a lot more stability in their political leadership compared to some more sketchy countries. So this is also something to look at as a global investor. How easy is it to invest in that country, right? And we can see short-term political risk. Obviously, South Africa has a lot more political risk compared to the United States. South Africa is good compared to some worse. For example, if you're investing in Venezuela, that's pretty corrupt compared to South Africa for the political risk. And we can see that the political risk in the short term and long term definitely favors the United States. All right, let's continue down here. So this is more for the investments in the actual country. Banking system stability. This is non-performing loans. So non-performing loans are loans that may need to be restructured or not. The loan is not performing as good as an investor would want. So they may have to restructure. There may be defaults. There's something that is not doing well. Obviously, it's not performing well, hence the name non-performing loan. And we can see United States is actually decreasing since 2008, so that's great. But then in South Africa, you see since 2017, 2018, and probably more in 2019, the trajectory is increasing. So you don't want to see non-performing loans increasing. You're seeing defaults on loans. You're seeing people and corporations not able to pay back their borrowed money, which no investor wants. So when you see the non-performing loans go down, you're seeing more stability in the investments in that nation. So obviously, South Africa is increasing the non-performing loans within that nation, so it's a little bit more bearish compared to the United States. All right, next thing we're going to be looking at is the innovation index, which is just looking at how much innovation is occurring in that country, as well as some high-tech exports, which is also important, and information technology and exports. So exports obviously play a really big role in an economy, and yeah, America is definitely beating them out on almost every single front in that sense. Economic freedom index, going to be another one. We see that freedom from corruption, America is doing better in. We have business freedom, which is actually going down in South Africa, which is not great. Going down in the United States as well, which is not great. Monetary freedom, you actually see South Africa going up, whereas the United States going down. And overall economic freedom, which is a key thing, is going to be way more skewed towards the United States. Last thing we're going to be doing is the saving percent of GDP. So this, in my view, is kind of going to be the velocity of currency. I couldn't find the velocity of currency for South Africa, but we can find it within the United States. And we know that since 2000, the velocity of currency has been going down significantly for the United States, which is deflationary, which is creating a stronger dollar. Whereas if you see less savings and more inflation for South Africa, that's going to be making the South African rand weaker. So if you have deflation in the United States, which is going to be strengthening the dollar, and then you're going to see inflation in South Africa because they're printing more and more currency, that's going to be a recipe for a really good potential trade. We're going to have strength in the dollar, weakness in the South African rand, and that could be a potential trade plan that you would be taking on in the foreign exchange market. Last thing we're going to be looking at is comparing these two currencies to different metals. So this is going to be the last thing we're going to be looking at before we're actually going to take a trip down TradingView and looking at some charts here. This is the last thing we're going to be looking at. So we're going to be comparing gold, silver, palladium, and palladium, or platinum. I don't know exactly how to say it. These two metals, platinum and palladium. Between these currencies, so we got United States dollar, CAD, Euro, GBP, Swiss franc, AUD, Canadian, Australian dollar, we got the South African rand, Hong Kong dollar, and Japanese yen. So we got all these different currencies that we are comparing the South African rand to when you are saying how many units does it take to buy 1 ounce of gold or silver or palladium. So it's going to give you a gauge when you don't want to compare one currency to another. You're comparing one currency to a hard asset that is not being controlled by any central bank. Because if two central banks are printing a shit ton of money, the ratio in which the units of one currency to the units of another currency may be exactly the same. But these two currencies may still be devaluing substantially compared to other more fixed supply assets like Bitcoin, gold, and silver. So let's first look at the United States dollar and the South African rand. So first, let's look at gold. We see that there's a pretty big push here, and this is the thing we're going to be looking at. The United States compared to gold, we haven't seen it go above the recent high of, in this case, it was around $1,800, $1,900 for the high of gold. But when we compare it to the South African rand, we are way, way above that within that same time frame. Meaning that the comparison of the the South African rand versus gold is way, way weaker than the United States dollar. So just in terms of comparing a currency to a hard asset, we can clearly see that the South African rand is much, much weaker when you are comparing it to gold versus the United States dollar. And let's just take a quick look here. This is the US dollar. This is CAD. Obviously, CAD is much weaker than the US dollar. It's way above the previous high there. Euro, a little bit better, right? GBP, much higher. And see, this is the currency that's actually been able to hold. The Swiss franc is actually a pretty strong currency compared to a lot of the other ones we've seen. Australian dollar getting demolished. The South African rand getting demolished. Hong Kong dollar actually holding up pretty well. Hong Kong dollar is actually doing pretty well compared to, for example, AUD, CAD, or the South African rand, and then the yen is getting demolished pretty well here as well. So comparing currencies to metals and not just currencies, comparing them to other, I kind of give you a good understanding of where that currency sits in relative strength. Kind of like you see me using the DXY, comparing the US dollar to not just one currency, but multiple currencies. And then we can see that silver is the same thing. When we're comparing silver to the dollar, we can see that it's a pretty, it's not even close to the high. And then when we go to the ZAR, it's very squished where the silver is almost at the high. So the South African rand is not holding really well compared to a lot of these other currencies. So let's look at the US dollar. Canada, this is going to be actually, Canada's doing pretty well compared to South Africa here. Euro, we can see, is a lot flatter. So Euro is doing not as good. GBP is doing pretty good. Swiss is doing pretty good. AUD is doing less because that is a lot lower down. So when the peak is higher, it's suppressing the price of gold, which means it's a lot stronger for that currency. And then South African rand is not doing good as well because the price is almost at the very high compared to, let's say, CAD, which is the price is not even close to the high that we saw back in 2010. So we can see, looking at the comparison versus the South African rand, compared to these different currencies and looking at some of these different metals, we can see the USD, huge move to the downside, and compared to the South African rand. South African rand's kind of midway, holding horizontally, whereas the United States dollar is moving down. So very different compared to these two different ones. Palladium, we're seeing a massive move to the upside. The South African rand should see even greater, and it definitely is. So you can play around with it. I've definitely looked at this, basically every single currency that we can see here and comparing them to different metals. So not just currency to currency, but also currency to metal, currency to other assets that are able to provide different perspective because central banks can print more of them. If you have two different assets that are debasing and devaluing at the same time, you're not really going to get a shift. You're going to get one for one. But if one thing, like a thing of gold or silver, compared to that currency, is going to give you a lot of different, it's going to give you a different perspective and a different result when you're comparing one thing to another. So that's going to be more of the fundamental drivers of this potential. And now this is going to be kind of the final structure that we're seeing. So we already talked about the fundamental interest rate cut that is providing a lot of strength for the South African rand. And because the market is kind of in an optimistic state where vaccines are being talked about, economies are being reopened, there's no major second wave, there's more optimism in the air, which makes sense right now. The S&P is going up. Overall, things are looking like it's in the hope stage before the potential next major leg down. So right now, the more risk on currency, which is the South African rand, is gaining traction, which makes sense in the fundamental grand scheme of things. And we can see right here, when we had that major liquidity event where the US dollar soared, this was that event, right? Especially at the start of March, we saw a massive move, around 25%, which is huge in the currency market. And now, in my opinion, we are getting a nice continuation pattern where you see a series of lower highs. We did break down after a series of higher lows, moving to the downside. So I'm not surprised that the South African rand is gaining some traction. But it's not just the currency-to-currency pair that we are looking at. We are also pairing the South African rand against gold. And this is the comparison versus gold to the South African rand. So right now, it takes just under 31,000 rand to buy 1 ounce of gold. This is what the chart is telling me. And it's not super important in my view, but it gives me a good understanding of, if I eliminate the United States dollar, how is the South African rand, how is it moving? Because if I just am looking at one thing to another, in the United States could be absolutely, the dollar could be absolutely rocketing, which is going to change the price of my pair, United States dollar, South African rand. But if it's just the gold to South African rand, this isn't going to change when the US dollar moves up or down. So looking at an asset not just in a one singular perspective definitely gives some different ways to view an asset. And then we have Japanese yen, South African rand. We can look at a bunch of different ones. So CHF, ZAR is also another one because the Swiss franc is also very strong. And we can see that the South African rand is getting weaker on compared to every single currency, basically. JPY versus ZAR, same thing. We're getting a major move up, which is a weakening of the ZAR, and then we're getting a pullback, which is completely normal. We can even view it, let's say, within another currency, Euro versus ZAR, which is also not a great currency for the Euro. Still, same thing. Actually, what's interesting is if we do something that's very weak, like a Turkish lira, even the Turkish lira is gaining compared to the South African rand here in 2020. So that definitely shows you something, because the Turkish lira is weakening quite a bit when we're comparing it to the United States dollar. Let's look at how aggressive it moved to the upside here on the Turkish lira compared to the United States dollar. Had a nice little squeeze and made a move up. And even comparing to the Turkish lira, the South African rand is looking like it is weakening. Maybe not so much. The ZAR is actually looking like it's strengthening compared to the Turkish lira, actually, because we had to move up. Nice little flag with a pull, and now we're getting a nice technical consolidation. So I misspoke on that one. In my opinion, the Turkish lira looks a little bit weaker than the South African rand, but overall, the South African rand is still pretty weak compared to a lot of the other currencies that we are looking at. Like, let's do Australian dollar. Obviously, very bullish. Let's do CAD. And we can see overall within the major currencies, South African rand is weakening compared to almost every single one. So if we're taking the approach that we talked about at the beginning, dollar milkshake theory, where the dollar will gain strength because there is a massive short squeeze on it, this means that overall, yes, the Turkish lira may be strong or maybe weaker than the South African rand, but in our currency analysis, the South African rand is pretty weak relatively to other currencies. So we're going to pick a relatively weak currency like the South African rand with potentially the strongest currency within the entire world, which is going to be the United States dollar. In terms of supply demand, there's going to be a lot of people who want to buy the United States dollar because they need to pay back their debts. They need to pay back their short position because if they continue, it could turn into a lot more money than they want. And I don't think anyone can just basically walk away from a position and say, I don't care what it gets to, because at the end of the day, we know that the dollar will devalue. That's a dangerous game. That's basically shorting Tesla at sub 200. It's saying, I don't care what it goes up to, because at the end of the day, I think that this company will inevitably go bankrupt. And if it goes to $1,000, if it goes to $5,000, you know, you're absolutely wrecked. And it's the same as an individual, as a country. If you're shorting, you might get squeezed if that asset that you are borrowing increases in price. So that's the trade that I'm kind of looking at if this does play through. Obviously, the South African rand is going up in price even compared to gold right now. So it's actually appreciating compared to gold. So there's no need to be looking for any trade whatsoever. And it did break to the downside, but in terms of the larger time frame, the next major swing that could occur, I think if there is another worry of some sort. Also, just a quick note, this is the stock market index. This is the Johannesburg, I believe, stock index. Johannesburg, I think that's the capital. But anyways, that's the stock market index for South Africa. So we got different pairs. We got gold compared to it, and then we got just the overall stock market, just because it's a good understanding of where their kind of financial economy is to some degree. If that's going down, obviously it's not super good for the economy. Overall, that's the structure of this trade that I think would be a good opportunity, and we'll see how it goes. This is going to be a trade that would be a lucrative trade if there is more worry, more economic turmoil, a second wave, more pain causing the global economy overall to take a next leg down. From the SPX short, I've definitely learned and read it a lot about how little there is to invest around the world. If you really think about it, in different indexes, United States may not have the best health, but it has better health than a lot of countries. And as a global investor, if you have millions of dollars, or millions of dollars in whatever currency you're looking at, if you're from another country, you're mainly going to be looking at the US. In short, really, right? So if you are trying to compare two currencies, what's going to have more demand? The world reserve currency, in which almost all commodities are traded by, that's going to have a shit ton of demand compared to a currency like the United States rand that does have a decent amount of interest in it that you could be yielding off of. But if there is any sort of negative downturn in the economy, you could be losing a significant portion of your wealth. So it's going to be a big question of, is foreign exchange global investors more worried? Are they in a risk-on environment in which they are conserving their wealth, protecting their wealth, looking for lower risk, lower yield investments for the long term? Or are they over this COVID? Do they think that there's going to be another expansion phase where there's going to be more optimism overall in the economy after this? And that's the question, right? That is the big question. But it's an opportunity that I think that I am, I'm not thinking about it. I'm looking at this opportunity as a potential good opportunity for the next major swing if it does move to the upside. So that's going to be the overall structure for this trade, and that's going to be the video. Thank you very much for watching, and hopefully you enjoyed it. There was definitely quite a bit of stuff that we went over within the markets. But I think it's just definitely a good opportunity here. I haven't been super active in the FX markets just because I've been more focused on cryptocurrencies, gold and silver to some degree, but I definitely love trading Forex. I love the idea of dissecting an economy and trying to get the more fundamental side of things. Obviously, we went over it briefly. I could get into more detail if I'd like, but there's only a certain amount of time that we can get into. So thank you very much for watching. If you have any questions, comments, insights, if you'd like links to the stuff that we went over, drop a comment section in the below drop a comment in the section below, sorry, and I'll be able to ask any questions or answer any questions that you have. Definitely, if you don't know about the dollar milkshake theory and you're wanting to learn more about this thesis by Brent Johnson, definitely look him up. He's all over YouTube, so it won't be hard to find him talking about his theory. He's basically long U.S. assets and U.S. currency and short basically everything else. Short odd, short Canadian dollars, odd meaning Australian dollars, Turkish lira, and yes, the South African rand as well. So he's extremely bullish on the US dollar because of this short squeeze that we've talked about. But at the end of the day, I think almost all economists can agree that this is unsustainable. You can't have a central bank print value forever at a rate of expanding the balance sheet of 10-12% a year. That just does not happen forever, for eternity. It just look at economic history. If you have an expanding balance sheet that is exponentially increasing at a rate of 10 or more % per year, there's just so much value that is going to get lost, that there's going to be some major debasement, and then once there's a certain threshold of confidence lost by a nation, of a population, they will switch to something that is able to hold their value more, because it's only going to get worse. Exponential increases or compound interest working against you has negative effects as time goes on, like positive compound interest has some positive effects over long periods of time. So I think people will sooner or later realize that they are in a situation and an environment in which if you hold fiat currencies for a long time, they're literally taking value away from you. And that is the current situation that we're in. And I think that's why I'm so bullish on gold, silver, and cryptocurrencies, is the fact that with the use of the internet, people are more aware. People are able to understand that they're getting their hours taken from them. If you work an hourly job, you're getting your time taken away from you. That is what it is. It's modern day slavery if they do enough of it. So that is the end game for them. For central banks, is they like having the power, they like having the control. And for everyday retail investors, traders, our goal is to protect ourselves from that depreciation of their currency, because it's inevitable. It'll happen. We're in a debt system where we can never, ever pay back the debt that is borrowed. And it's just the cycle, right? And if they create negative interest rates, well, then the people that have been saving this entire time are going to get wrecked. So either way, currencies are not a good place to store wealth over a long period of time. It is basically the end of this video, is kind of the last statement I like to make. So thank you very much for watching. Yes, we did talk about the United States being a strengthening deflationary store of value in the short term, which I think it will be compared to other currencies. But in terms of the long term, I don't think any fiat currencies is great to hold on to value. I think that the best bet is going to be for cryptos and precious metals for being able to hold wealth in a long-term horizon. Thank you very much for watching. Hopefully you enjoyed it. Until next time, have a good one.